Thanks, Adishan. Evening, ladies and gents. Well, I suppose lesson number 0 is trying to predict markets. Trying to predict anything is immensely hard, right? We understand that the weather forecasts aren't right half the time. Chaos theory came from meteorologists in the 50s who discovered that small little tweaks in their modeling had significant implications down the line. So I'm going to try and, to a fair degree, stay away from trying to predict too much, but we will, and I need to get... It always does work. That is me, day one, school, 1976, Ladysmith. I look a little vampirish, don't I? For the record, I hated school, and that was fine. School hated me. It was a symbiotic relationship in that regard. So as you can work out, I was born 69. That was me in Ladysmith. Edgerton Primary was the name of the school. I got interested in the markets in the 90s. My grandfather had traded the bucket shops in Durban. He would, weirdly enough, make money in the bucket shops, and then he would go to Greyville, the race course, in the weekend and lose the money at the race course. But anyway, he got me sort of interested in it. We have to remember that back then there wasn't anything, right? There was no radio shows. There was nothing. I mean, I would at some point, what was then Springbok Radio at the 6 o'clock news would give you the closing prices of all the JSE listed shares. And I would write down the ones that interested me and make my own data and charts and everything. And then we started getting the JSE handbook. And then I was in Durban, the Sunday Tribune started doing a column. I forget the man's name, but he had the Blue Royals. Yeah. I forget, anyway, and so I started to get interest. I bought my first shares in 87, a couple of weeks before the crash. I was a decent back then. And that was a sobering experience. I got more interested in the 90s, so I suppose sort of 93, 94, 95. I didn't know what I thought I knew what I was doing, but not very massively. I founded a website called SA Warrants in 2000. It was also 2000 was my first profitable year in trading. I'm not going to talk a lot about trading this evening. We've got some power hours that we've done trading before. You can go find those, justonelap.com/power hour. I joined Standard Online Share Trading in 2007, left in 2010, founded Just One Lap in 2011, and here we are. I know there's a big gap between 2011 and now, but basically it's been 14 years of talking one way or another. Talking's what I do best and perhaps most of the time. Why am I sort of the one to stand up here and talk about the 10 lessons? Not because I'm necessarily the best or the smartest or anything, but because I've got the 30 years and I've got the scars. And a lot of what I'm going to talk about today, this evening, is things that I really had to learn the hard way. I like to think that I do learn and that I do change my mind, but that I am a slow learner and a stubborn changer of my mind. Don't show me once or twice or thrice. Like, rub my nose in it like half a dozen times, maybe a dozen times. Now I'm really starting to learn, and I might start to change my mind. It also took me a fair bit of time, and maybe this is lesson 0, to understand that if I am fighting the market, I will lose every single time. My opinion is immaterial, and my ability to win a fight against the market is 0. What matters is what's happening in the market, and all I can do is really learn to respond to that. And there are a couple of tricks for how we learn to respond to that, and we'll touch on some of them this evening. Lesson 1 is just that thinking long term is hard. And if you read Thinking Fast and Slow by a Nobel-winning economist, you learn. He talks around that whole process of how we are as humans wired for the short-term thinking. And really, the longer we go out in our time horizon, the easier investing is. You bring me an 18-year-old starting their first job, and they want to retire at the age of 65 with enough money to retire. It is the easiest thing in the world. Save 12 or 15% of your salary into ETFs, come back at 65, done deal. It's just that simple. Of course, we don't want to wait to 65, we start late, we think we can get rich in a hurry, we got plans for the weekend, we want that gratification, but we need to wire our brains to truly understanding what we're trying to do. And as we push the time out, it becomes easier. And take a share, any share, not any share, that would be silly. Let's take the JSE. Just as an overall, what did we close today? 99,000 odd points. Where's it going to be tomorrow, next week? Don't know. Higher, lower, not sure. In a year's time, I would say higher, but I can't be sure. 10 years time, it's going to be higher. I mean, it's just, look, if it isn't higher, we've all moved to Zimbabwe and nothing matters. But it's going to be higher. And that's just the point, that as we look out further, it becomes so much easier to actually do the investing, to actually say to yourself, well, I don't know what's going to happen in the days, weeks, months, and years ahead, but I do know what's going to happen in the decades ahead. And in the decades ahead, the JSE index or share will be higher, in part because it's a self-fulfilling prophecy, right? What's an index? It's a bunch of stocks, and the bad ones fall out the bottom and the new winners come in. So it's a self-cleaning process. And by that very nature, it says to you, well, I will be higher in a decade, in a week and stuff, who absolutely knows? So we've got to get used to that idea where we are not even trying to predict the future. We're just trying to think around probabilities. And the further out we push those probabilities, the easier it becomes. And then when we start to overlay, and I'm going to come into this in more detail in a moment, when we start to overlay some sort of big picture thinking over it, it becomes so much easier. So if we start to think to ourselves, I mean, just a quick example, and let's go back 5 years ago, before really artificial intelligence was anything. You know, was NVIDIA always going to be around? Yes, of course, but we didn't understand that they had the chip of the future. Is NVIDIA still going to have the chip of the future in 5 or 10 years? Don't know. Don't know. I mean, right now they're Blackwell, they're Grace Hoppers, they're H100s. They are well ahead of competition. Will that remain? I would say no, but I don't know. Flip it the other way. Are we still going to be eating as people in a year or 5 or 10 or 20? Well, yeah, of course we are. Ergo, a food retailer. Simple stuff like that. You start to think about that. The other point around long term is don't be tempted to raid your portfolio. And it's probably one of the things that I've done best, is that I haven't raided my portfolio. That temptation to, I don't know, you want to buy a house, a car, a holiday, something like that. Let me just sell X rands worth of something and spend it. Quite simply, take that X rand of something, grow it at 2x inflation and see what it's going to be worth at your retirement. And suddenly it's like, yo, hang on, do I really need a holiday in Belize or wherever the hot holiday stuff is? And that requires a first thought, which is put the capital in that you can really commit. Don't say, hey, I've got $100 I don't need till Christmas. No, don't need till Christmas is no good. Say I've got $100 that I don't need. End of story. I don't need it. And then resist the temptation to sell. Selling does a couple of things. Firstly, there's transaction fees. They're irrelevant in the big picture. There's tax. If you've made a profit, now you're going to get taxed on it, and now you're out of that position. And that perhaps is the crucial part, is that you owned a great stock, but you sold it because you wanted to have a weekend away, and you don't own it anymore, and it's a higher price, and your brain is just hurting. The ability to not raid your portfolio. So lesson one is thinking that long term is important and immensely hard. And then the story matters. And I'm going to, a couple of ways. And what I mean, let's start big picture. When I started to think about this, and I'm going back almost 20 years now, I heard an interview and I have no idea where or who or what, so I can't credit them. But the person who was being interviewed said, what is your big picture thinking around your investment philosophy? And mine was, a couple of things, but broadly the same, particularly to emerging economies, South Africa, China, the like, but truthfully, developed economies, Europe, North America, people are moving to the cities, people are getting richer, people are living longer, but they're moving to the cities and getting richer has all sorts of implications. That first generation who moves to the city, not much for them. But their kids are very quickly have got cell phones and medical cover and going to school and moving up that ladder of consumption. And I looked at it and thought, this is a consumption story. Absolutely, this is about consumption. I want to focus a lot of my investing on that increased consumption. Now, what does increased consumption mean? We're eating. And to be clear, a person, I mean, China took what, 500 million people from rural to cities. In rural, you're eating, but you're subsistence. In the city, you're buying at the store. It's that, and that's ShopRite. I was a big believer in telcos for a while. I no longer believe in telcos. I think they're utilities with an overly large capex that's going to hurt them, because 5G is lacquer, but trust me, 6G is coming soon enough. And then as soon as you've installed 6G, you start ripping it out and putting 7G and whatever the Gs are. What is the big picture? And I want to give you an example which is relevant to right now. Artificial intelligence. And I argue sometimes the intelligence part, but let's just say that it is intelligent. It's certainly artificial. Is it going to change the world? Yes. Is it going to be completely ubiquitous in time? Yes. But think of it more like the internet, right? We're all trying to find that winner in the AI space. Let's go back 25 years ago when the internet was coming. And it was, if you were a listed company and you added .com to your name of your company, just add .com. Don't do it .com. Add .com, or maybe be really clever and actually have a website. Your stock on the NASDAQ could triple in a week just because you added .com. We thought that individual companies were going to be, but these days, having a website is just table stakes. Internet is now literally ubiquitous. Everything is happening on the internet, from ordering our food to doing our banking and everything else. The internet is now just a part of our life. And that's what I think is going to happen in AI. So Microsoft can tell you that they winner, chicken dinner. Sure, but they are for now. Everyone's going to have it. And yes, the server farms are doing great. AWS, Azure, at Microsoft, all the others, Oracle, their server farms are making fortunes, but ultimately everyone's going to have server farms, because again, that's just going to be table stakes. Artificial intelligence is just going to be there. Is it going to be, so okay, so the current winners, the Alphabets, although we can put a query around that, the Microsofts, those sort of, the Metas, those sort of companies, are they massively benefiting from artificial intelligence? Yes. But I don't think that edge lasts with them forever. I think they're ahead, but I think eventually everyone else rises and they sink and it just becomes ubiquitous. So we then go to the other part. Well, how else do we look at artificial intelligence? Well, we've got NVIDIA. They currently, out and out, have got the best chip stack that there is. They've got their CUDA software, which locks you in, etc., etc. But is that going to be the case in 5, 10, 20 years? I don't know. I find it hard to believe, is the honest answer. So then we can look at other parts of that value chain as well. What about someone like a TSMC who make the chips, or an AMD, or one of the chip, Intel, although Intel's got a big asterisk next to it as well, the chip manufacturers. And then we can go even further back in the line, which is ASML, the Dutch company who make the ultraviolet lithograph machines, which enable you to do the 3-nanometer chips. So you've said AI is the answer, and immediately it's like, well, then I must buy NVIDIA. But it's like, well, hang on a second. If AI is the answer, there's many different ways that we can play it. And which of those companies have got true moats? NVIDIA, sure, but it's a narrow moat. Microsoft and the others, yes, but it's a narrow moat. TSMC, yes, but they've already got competition. And yes, their ability to do 4-nanometer puts them well ahead of many of the other players out there. But trust me, everyone's working on it. AWS is trying to make their own bespoke chips, as is Microsoft, as is Facebook. So then maybe it's TSMC, because if you want to make these 3 and 4-nanometer chips, there is one way you can do it with the ultraviolet lithograph. And when you go and read about it, that came out of DARPA. This isn't a sudden thing that popped up and it's like, yo, okay, so they've got it and others will come. The tech that they have is not open source, but it was open. It was developed by the US government back in the 80s and into the 90s. TSMC were the only ones who were able to make it practical and actually make it work. So it's understanding the different players in the space. When I look at food, I like food retailers, but I don't want the top end, because when times are tough, we shop down. I want the middle end, and truthfully, ShopRite gives you a bit of everything these days. When you're rich, you're at Checkers. When you're not so rich, you're at ShopRite. When times are tough, you're at not Boxer, you save. Boxer, of course, is Pick and Pay. But you've got that line there, whereas your Woolies is kind of the top end. And then Boxer's kind of the bottom end. Now, Boxer's probably more resilient, because there's always going to be people moving up and down through their potential channels. I don't want food producers. Because who's got the power in the food producer? ShopRite. ShopRite phones them and says, look, I want 1 million tins of baked beans, but here's the price I'm going to pay. You're going to deliver it here, and I'm going to pay you at 120 days. And you say, I don't like the terms. They put the phone down and they phone somebody else, because you know what? A baked bean is fungible. I know Q disagrees, but really they're all baked beans. So it's understanding where that power plays within that big theme. So get what that big picture is and understand the different parts of the story, and then understand why you buy the story and what breaks the story. That's because, quite frankly, right now you might be listening to me and you might be saying, yeah, but Simon, NVIDIA is so far ahead, it's got 5 or 10 years, and I'm happy to ride it for 4 to 9 years and exit just before things go wrong. Fair enough. Know what breaks the story. And that's the critical part. And I'm coming back to it, but I'm going to touch on it now. When I buy shares for the long term, I write down the 3 reasons I like it, and I write down the 3 risks. And when results come out, I compare what is happening to what I'm expecting. And that's what matters. So it's not to say, don't do NVIDIA, but to start to say, okay, I've got NVIDIA. They've definitely got a tech lead. What are the signs that that tech lead starts to break away? And that is then the risk to NVIDIA's future going forward. Second question, can NVIDIA 10x from here? Can it become a $40 trillion company? It can, but you have to understand how much AI you folks have to be using every day to make that number viable. The numbers just start to become impossible to do. They are already selling chips hand over fist. If they're now going to be selling 10x the number of chips, and probably at lower prices and margins, so maybe it's 15x the number of chips, it's like, hang on a second. I mean, that is an insane amount of demand. So understand what the story is, the different parts of it, and what you like and what breaks it. Hugely important. And what breaking is always important. When we're investing, we spend all our time focusing on the winner-winner part. We've got to sort of know when we're going to be exiting, but I'm going to get to selling in a moment, because selling really, really is hard. Valuation matters. Even the best business at the wrong price is a bad business or a bad investment. Valuations matter. That doesn't mean that you can't buy Capitec on a 99 PE, because when Capitec was on a 99 PE, the stock was 40 Rand. Now it's on a 30 PE and the stock is 3,500. But if you're buying a 99 PE, your question is, can this thing grow into that PE? Can it double earnings every year for the next 3 years? With Capitec, the answer was yes. NVIDIA just 3 years ago was on a 75 PE. That 75 PE is now wound down to a 30, 32 PE. So valuations do matter, and it doesn't mean that you can't buy the high valued, it just means they've got to grow into it. Here's an example, Costco. Costco is kind of like Macro, right? You pay a subscription service and then they sell you cheap stuff. The PE is 50, 50. I want a high growth company for a 50 PE. Costco is many things, all of them good, none of them high growth. If you buy a good business at a high price, you're making profit on it is immensely hard. So valuations matter. The price that we pay is what we control. Once you've bought the stock, you have no more control left. You don't control what price you sell it. You don't control earnings. You don't control nothing. But the price you pay matters, and patience. But keep your evaluations simple, because even your quality sometimes become cheaper. And I'm going to give you an example, and I'm going to use this as 10 years of ShopRite data. The blue line is the price earnings, and the orange line is the forward price earnings. In other words, today's share price, next year's expected headline earnings per share. Now, of course, the expected part can go wrong in many, many ways. What we've essentially got here is a mean of 21.1. So currently, ShopRite PE is on 21.4, which means it's fairly priced. But I use forward. The forward PE is 18.6. So they're assuming a growth in earnings of about 12%. I think that's a little rich, but let's use it for this equation. The forward PE is at 18.6. That is a standard deviation below, more than a standard deviation below the 10-year mean. The times that has happened before, you were picking it up at this point here at about 170. You were picking it up in the lockdown era at about 100 Rand. Today, ShopRite is around 270. It's been as high as 350. You don't want to be buying ShopRite when it is more above the standard deviation. You want to be buying it when it's below. So do you buy ShopRite every day of the week? No, you buy ShopRite when the valuation is working. Now, truthfully, so right now I think at 270, ShopRite is looking quite good. And in fact, there was a stock pick on Stockwatch this evening. Oh, that only airs in 40 minutes. I never said anything. We're pre-recorded. I'm not time traveling. You wait for the good price, and that price might actually practically, let's go back to a period here, 2018ish or so. ShopRite was trading, and I think it was trading about 185, and everything was expensive about it. Fast forward to well, let's take it now. It's 270. It's a whole lot more expensive in terms of rands, but not in terms of valuation. Nice, simple. And that data you can do manually. You can grab it off OST. They give you the historic PEs. I use Koifin. There's a free version. You can grab it there. Nice and simple. You can get the paid version. And I use that for my valuations. I am not doing DCFs or anything like that. But what it does is identify what I like. And then I stand back and I wait for the price to come to me. And the price is truthfully the valuation. You can do similar on a dividend yield. You can use it on many other metrics within. I like PE because it brings out the two key components, price and what we're seeing in earnings. And that comes out in one number. Always buy the best. The temptation is to say that you like food retail because we're always going to be eating. So you go and buy Pick and Pay, the loser. And you think because one day Pick and Pay will become the winner. 20 years later, Pick and Pay still ain't the winner. Couple of reasons. Firstly, the winners know how to win. It's in their DNA. Secondly, they are running at high speed. Pick and Pay doesn't just need to catch up, they then need to overtake. Now, they could catch up because ShopRite stumbles, which is what happened. In the 90s, Pick and Pay was the leader. And then their margin started to compress. When I bought my ShopRite shares in about 2004 or 5 was my first purchase. At that point, the reason I bought it was because they were getting expanding margins and Pick and Pay was seeing contracting. ShopRite runs on food retailers with over 1,000 stores. ShopRite has the best operating margin on planet Earth. And what you could see, what their margins were going to get only better. Why? Because they were starting to invest into distribution centers. And you could see Pick and Pay was paying a better dividend and paying more of the profits as dividend. But I'm like, yo guys, you need to reinvest back into the business. You can't always, just say we're Pick and Pay, come to us. You need to invest back in to get those margins, to get that traffic. When you're looking at a sector, buy the best. Wait for it to be at the valuation. If you're right now saying, should I buy Intel, AMD, or NVIDIA? And you say, no, I'm going to buy Intel because, man, that thing hasn't made a good chip in 20 years, but next year it will. Why is it going to suddenly turn it around? Can it? Yes. Will it? How long will it take? To be clear, Intel's been turning around for 10 years. And the share is at a 10-year low last time I checked. I've stopped looking because I got a friend who owns Intel and he keeps on saying, have you bought yet? I'm like, no, dude. I got NVIDIA. I don't. Buy the winner. They know how to win. You go and buy second place, they know how to be second. You're buying it because you're saying, I'm going to buy second place, and one day second place will overtake and be number one. Well, no, buy number one, and when second place overtakes, switch your bets. You can do that. This is a market. I used to own Pick and Pay because it was the bluest of blue chips. And then it wasn't. So then I switched into ShopRite. And here is 20 years of data. ShopRite, Woolies, Spar, Pick and Pay. For as long as I can remember, people have been saying, Pick and Pay is coming back. The data told 110%. Now, that's not fair because you got Boxer shares as well. Let's double it and call it 220%. 220% in 20 years investing is not even inflation. No, maybe it's nothing. It is just a nothing return. What you will see is that there were periods here when Woolies was doing better. There were periods even when Spar did better. So if you're looking at this, you say to yourself, well, I rode the ShopRite to 2013. I got out into Spar, into Woolies. I rode that to 2016. I got back into ShopRite, and then I got into, and you all know how that's working. It's nice and easy looking backwards. Looking forwards, it's a whole lot different. I used to own Woolies as well. I owned Woolies for the best ROE available in the business. They had a food business that was for just an insane, it still is an insane business. Back then it was very much a more high end, and they had a good clothing business. Three things have happened. People are coming for their food business as ShopRite and the like move up in the stack. Their clothing has become an utter disaster, and they did a move into Australia. Bonus lesson: the stock you own does a big merger. It'll rally. Sell. Trust me, just sell. I mean, I can list you the examples if you want. And this is not just a South Africa story. There have been more MBAs done on M&A activity than you can imagine. And the short answer is something like about 1 in 4 M&As actually make shareholder value. 1 in 4. In other words, 3 in 4 don't. So Famous Brands did their jaunt offshore, ended in tears. Woolies did their jaunt offshore, ended in tears. Supergroup did a jaunt offshore and made a fortune. But I'm trying to think of another supergroup. Tiger Brands, when the richest man in Africa sells you a business, the best thing you should do is walk away. So he sold it to Tiger Brands for a couple of billion, 3 billion, and bought it back for 1. No, not 1 billion, 1 rand. Paid 3 billion, bought it back for 1. Dangote. When the richest man in Africa says, I've got something to sell you, your job is, gent, I like you, but I'm busy. Why do you think he's the richest man in Africa? Come on. So buy the winners. Buy winners. I know the temptation is to buy the dog. But then in 5 years' time, I'm going to be having to tell you that when you open your portfolio and there's a share that makes you cry, it's because it's a dog and you should sell it. And that's just sad. Cash is not king. Cash is a drag. It gives you low return. You got to get taxed on it. I know why we have cash. We have cash because we're waiting for the next collapse. The market's going to collapse and we're going to buy it all and we're going to retire rich. And the problem is the market will crash, but we don't know when. And when it does crash, it's hard to have that courage to actually go into the market and be a buyer. Cash is a drag. Some case, I mean, everyone's like, oh, Warren Buffett, back in April when the Liberation Day nonsense started, and everyone was like, oh, look at Buffett, so clever, he's got hundreds of billions of cash. So Berkshire Hathaway this year is down 3% and the S&P is up 6%. I mean, he's just getting whipped. Cash is a drag. Makes you look clever at times. Now, truthfully, Buffett has other problems. When you've got hundreds of billions, you can't, I mean, deploying it is hard. I mean, he could buy the JSE in its entirety and you'll still have change to go and do something else. So, you know, the whole idea is that, and I used to do this, I would have lots of cash. And my problem was I was very slow to respond to the reality. And I'll give you an example. 2000, we had the dot-com collapse. And then we have 9/11, our rand goes crazy, and then the rand collapses and our market collapses. Our rand goes to 1361 in December 2001, and everything is horrible, and it's bear markets, and everything is ugly. My problem was, that's 2001. In 2004, I'm still bearish, and I'm collecting cash. The market's been going up and up and up, and I keep on saying, yeah, but the market's wrong. It's going to collapse. Don't worry. The market's wrong. It's going to collapse. And when it does collapse, man, look at all this cash I've got, and I'm going to swoop in and buy it. It didn't collapse. I take that back. It did collapse in 2007. By then, our market had rallied hundreds of percents. And when it crashed to way above where the levels were, where I thought it was, you know, I was expecting remember in the pandemic, oh, it's a W recession. And we go back to 2008. Oh, yes, it's recovered, but it's going to crash again. It might. But that is not an investment strategy. Because more often than not, it doesn't crash again. It almost just carries on going because that's largely what markets do. Markets go higher. They are designed to go higher by the structure of an index. They're designed to go higher because there is inflation and that gives companies pricing power. They're designed to go higher because money is being printed and pushed into the system and it needs a home to go to, and that home is primarily the equity market. In April of 2020, hard lockdown, we bought some RSA retail savings bonds, 11.5% yield over 5 years. And you think to yourself, 11.5%, 5 years? Nice, I'll take that. JSE's beaten the pants off that. And that includes the bear market of 2022. cash is a drag. Now, there might be strategic allocations for cash. Maybe you need some cash for living expenses. Maybe you're waiting for, some valuations. Maybe everything just looks a little bit frothy, but don't just sort of build that cash. An amount, a couple of percent, 2%, 5%, something like that. Maybe a bit of cash. I typically run close to zero. At this point, there's a new structured product coming out from Standard Bank, and it looks really, really nice, but I don't have very much cash. So I go and check, okay, check the listing date of it, because dividend flow will generate me some cash. And I'm not going to sell anything. There's nothing in my portfolio I don't like right now, so I'm not going to be a seller of anything. That dividend would generate it for me. But cash is drag, particularly when you're sitting on 20, 30, 40% cash. I know fund managers who have discretionary portfolios. In other words, there's no CISA regulation or anything. And beginning of last year, beginning of 2024, they were sitting about 40% cash. It's a global multi-asset portfolio, 40% cash. Their return has been around 4.5% annualized since then. 4.5%. Hey, my RSA retail bonds have beaten that, but the JSE's probably up, and JSE's probably, 40, 45%. The S&P probably about the same. The NASDAQ probably about the same. And they were saying, yeah, but you know what, and they had a brilliant story about why they should have so much cash, except it's a drag. And you know what, markets will crash one day. We just don't know which day. That's always the problem. They crash one day, we have no idea when. So yeah, maybe have a little bit. Maybe use dividend income. I'm putting money in most months. I got dividend flow coming through. Some months are much better in dividends because of period ends. Most companies are year-end February or December, so you get the bigger dividends sort of March to June. Lovely dividend harvesting then. And then sort of last quarter of the year, I get more dividends, but less because it's usually interim, not the finals. But cash is not an investment strategy by any stretch of imagination. This remains the hardest part of investing for me, selling. Now, let me quickly give you a description of my portfolio. At the bottom, I've got my ETFs. Mostly I don't sell them because I got broad-based ETFs. I got some thematic, but mostly broad-based. I just saw my buy. Then I've got what I call my death to us part portfolio. These are shares that I hope to own when I die or when they die, whichever happens first. There have been some that have died on me. MTN was a case in point, and MTN's case in point is that management matters more than we know how much management matters. The MTN story is quite simple. It's 2015. So 2015, it's October. My wife and I, my sister, her family, we're down at Salt Rock. We're having a holiday. I get a message from a friend on the Sunday. He says there's reports out of Nigeria that MTN has been fined $5.5 billion by the Nigerian authorities. I'm like, dude, this is nonsense. Absolute bogus. He sends me the link. Looks real. I message someone I know in Nigeria. I say, is this a real publication or is this? He's like, no, it's legit. It's a daily newspaper. This is real. I'm like, okay, this is really bad, but you know what? It's Sunday. Nothing I can do. 7 o'clock tomorrow morning, MTN will issue a SENS announcement and I can make a decision. MTN issued a SENS announcement at 2:15 on Monday afternoon. One question, what were they doing for 7 hours and 15 minutes? They were trying to figure a way to spin the story. That SENS hit the news wires. I sold my MTNs immediately. Fun fact, I sold them at 175 Rand. MTN is not that price right now, 10 years later. Management matters. If you don't trust them, and my hotness, if they lied to you, and frankly, in this case, MTN lied by omission. Why did they wait 7 hours and 15 minutes for something that by 2:15 in the afternoon, I had known for 24 hours, and truthfully, so had everybody else in the market. I wasn't special in that regard. Everyone else knew that story at the same time. So my problem, so I've got my death to us pot. The plan is I hold it forever. And then occasionally I have a rush of blood to my head and I decide to sell something. And you know what? It's never good. It's almost never good. I then have what I call my second tier portfolio, where I buy sort of mostly mid caps and the like. And there I've got things like Colgrow, my Renogens were sitting in there, I know, my Purple are sitting in there. These are not stocks I plan to hold forever. These are stocks I plan to hold because I like the story. They're going to be rising, and at some point I will sell them. I typically hold those stocks anything from a couple of years to maybe a decade. I held Colgrow the first time I bought it for over 10 years. I bought it at 2, I sold it at 21. Another fun fact, did I sell it at 21? I sold 90% of it at 21. Why did I keep 10%? I mean, I'm asking because I don't know. I'm hoping one of you guys know. Lady, somebody? Sentiment. That is a brilliant answer. Sentiment is what I'm going to put on it because I don't know why else I did it. And of course, the other 10% I sold at 9 Rand. Yeah, I know. Yeah, you see the problem. You see the problem. And then I've got my trading portfolio at the top. And it's sort of 60, 55%, 30%, 10 or 15%, and then some trading at the top. So my desk to us part, I go back to know what you like about the business, those 3 things, know what the risks are, at least 3 key risks. Keep an eye on those. When they start to break down, maybe this is a signal. My ShopRite key things are quite simple. Dominant in distribution, dominant in management innovation, 60/60 pays that out. And these are things I wrote down in 2004, and dominant in operating margin. All 3 are still there. The risks are Pick and Pay. Well, I need to upgrade that because maybe they are now. Pick and Pay, foreigners coming into the market, and I can't remember the third. But I know very clearly what I like, what I worry about, and as long as those remain largely in place, and in something like ShopRite, there's not going to be much change. If you've got a tech company or something, those might shift around a bit as things evolve, but selling food is selling food. I know why I like it. So when ShopRite goes to 350, I do nothing. When it goes to 100, I do nothing, because those 3 are in place. And what you will see with stocks like ShopRite, Capitec, those high value companies, is they run and then they consolidate. And then they run and then they consolidate. How long's that consolidation? Months, years, who knows? But what it does is while it's consolidating, earnings are coming up behind it and the valuation is coming down, and eventually you get that opportunity to buy again. They basically overextend. If I was an active manager and any good at my job as being an active manager, when it rallied, you sell it and then it falls and you buy it and you rally and you is the theory. The practice, of course, we know is another whole kettle of fish. In my second tier portfolio, man, I struggle with the selling part. I sold too early. I sold too late. I don't sell it all because sentiment. That to me is the really, really hard. I bought my Renogens at 12. They went to 40. I think they're now 15, but I still hold them. And en route, they went 12, 46, 15. Why do I still hold them? Well, truth be told, because ASP Isotopes, who's buying them out, is becoming a meme stock. If you go look at the Wall Street bets and hot copper in Australia and stuff, it's becoming a bit of a meme stock, and I am not adverse to getting onto the bandwagon of a meme stock. I'm not sure if I want to hold ASP Isotopes, but if a stock I hold already becomes meme, well, then I will take whatever money I possibly can if there is any for me. Oh, meme stock, where the internet bulletin boards are just hyping it up and everyone must own it and stuff. So back in the day, it would be chat groups, the Reddits and the Twitters and the Facebooks, where everyone's like, this is the best. But look, to be clear, there are millions, well, not millions, thousands of stocks every day where people are saying, this is the best penny stock in the world to buy, and 999 do something. Sometimes one of them catches on. GameStop was an example during the pandemic, and some others. Stocks that there's a sniff of a story, and that story just, the internet just turns it into something crazy, and that just sucks people in, and then it gets crazier, it becomes self-fulfilling. So everyone who was saying to buy ASP Isotopes at $7 and now it's 15 are like, I told you so, but there's still value. And most people would be like, you know, this thing's doubled, where's the value? But that meme stock is just, it continues and continues. And there's easy ways to do it. Just go to Reddit and put the share code and see what happens. Go to Hot Copper in Australia, put the share code in, and monitor number of mentions. So ASP Isotopes, by about 4 or 5 months ago, I interviewed them because they were doing a secondary listing on the JSE, and I went to Hot Copper, there was nothing. I went to Reddit, there were, I forget the number, I've got it in a spreadsheet, number of posts. I went back a month later, the number of posts was up about 10%. I went back a month later, and the number of posts had quadrupled. And when I went back another month later, it had gone up tenfold. In other words, the talk around the stock is just doing that. Now, it could be negative, but the price action tells me it's positive. And in that period, they've announced the buyout of Renogen. The problem with these is that the valuations become crazy. I mean, Calgro M3 at 21 Rand was ridiculous. That stock wasn't worth more than 5 or 6. But you know what? That was true at 10 Rand and 15 and 20 and 21. So that's the part I really, really struggle with, which is why I like to think that I sell a bit and hold on to the rest. The evidence is that that's not always the best idea either. The point is, I suppose, is I need to get comfortable that when you've got a stock that's up 10x in 5 years, firstly, is it going to 10x again? Calgro was not going to a 200 Rand share. So I wasn't getting another 10x in the next 5 years. Secondly, I've 10x'd in 5 years. Like, why aren't I happy? Again, I'm asking. 10x in 5 years, take the money and run. FOMO. Oh no, you've accused me of FOMO. But I mean, you're right. No, you're 100% right.
I think it might still go further.
But
it was 15.
I know, and it did. At 15, it went up another 50%. And that is earlier when I said to you, can NVIDIA become a 40 trillion? I like to play that in my head. And I forget the market cap of Calgro. But, you know, it had gone up 10x already. That was quite chunky. If it went up another 10x, I mean, now is it knocking on the door of being a top 40? Is Calgro M3 a top 40 stock? I love it. Makes housing hugely important, massive demand, but top 40? I mean, is that much money in housing? I mean, so maybe that's the question I need to think about is it's 10x, can it 10x again? And they don't all 10x. I mean, they absolutely don't. And then sometimes I do it better than others. My purples, bought at 50, sold at 350, bought back again at 50. But I'm telling you that because that is the best story I have in terms of timing. There's no, and I did it again here and here and here. I did it once and I'm proud of it. So I tell people. All the shares I'm talking about, simonbrown.co, my portfolio is listed publicly, not because you should rush off and buy it, but just as a disclaimer so that you don't accuse me of front running my own shares. It is hard. The selling part is hard. What I'm trying to do, and I'm going back to Atomic Habits, what I'm trying to do is build better structure around those second tier stocks. The top ones, I don't do it well, but I've got a structure in place. I just don't always follow it. The second tier stocks, the Renogens, the Calgros, all of those, I need a much better plan in place on what I exit. And that might just be a case of, can it 10x from here? And if the answer starts to become, then I need to start thinking about maybe taking some money. And my position sizes aren't big enough that I can, you know, let 10% go and 10% go and et cetera, et cetera. So selling is hard, very hard. And it's fear. It's fear of all-time highs. Our market is currently at all-time highs. It is, and when you think about the psychology of an all-time high, it's actually a beautiful thing. Someone bought a share today and paid a price that no one has ever paid before. And the confidence, you don't walk into a BMW dealership and say, you see that price? I want to pay more. Tell you what, I'll come back tomorrow, make it higher. But that's what's happening in the market. Every day there's new highs. Sometimes it's individual stocks, sometimes it's a collective. New highs. The psychology of a new high in a market is immensely powerful. And it's not just one person. It's 100 people who came to BMW and said, yeah, I want to pay more. 1,000, many thousand. Hugely important. Now, do markets get overvalued? Do valuations become stretched and completely crazy? Of course they do. But then we don't sell and say, well, markets are expensive, because where do you sell? Did you sell when the NASDAQ was at 75% quartile expensive? Because that was 40% ago. Do you sell when it's 95% quartile expensive? Because that was January. Do you sell when it's 97 quartile expensive? Because that's today. At some point, the NASDAQ will be the most expensive in terms of valuation than it's ever been in the history of the NASDAQ. You know what? I want to be owning it when that happens. I want to be in that rarefied air. Does that mean, is that sustainable? No, of course not. And truthfully, the last time it was at 100%, it was back in .com. But don't be scared, and particularly in your long-term portfolio, all-time highs, no stress. Your mid-tier portfolio, all-time highs, no stress. What you might not be doing at all-time highs is buying. Would I buy Nvidia at $175? Nah. 150 before it was breaking out? Sure. $100 a few months ago when it was collapsing back in April? Heck yeah. My ETFs, every month I have a debit order. It goes and buys me an ETF. I buy the 10X Global. The code is Global. I buy that every month, irrelevant. So I'm buying it. It's at record levels, but you know what? I got time on my side. Markets will crash. It'll be ugly, but I will survive and everything will be fine. I've got time on my side. If I was 75, it might be a slightly different story. We get scared of lows. We all say we're waiting for the market to crash. And then it does crash and we're like, yo, ho, 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 looky, looky, how much lower can it go? The answer is we don't know. So, I mean, 5 and 10% corrections are just those things that happen all the time. 20% corrections should happen every couple of years. 40% corrections, 50% corrections should happen about once a decade. This is just what markets do. They get frothy, they come back down. And much rather a collapse than a sideways move as the valuation unravels. The ASX in Australia did the sideways move, where for about 4 or 5 years, the market basically went sideways while valuations caught up. Way better just to make it crash. So don't be scared when things go low. Maybe be cautious. So 2008, so the first couple of market crashes, I was terrible. Go listen to one of my podcasts. I talk about it, worldwide markets. I talk around anatomy of financial crises, 87 to date, and how I responded and what I learned. The 2008-9 crisis was the first time I responded well to a crisis, because all the previous crises I panicked and I did stupid things. And in 08-09, I'm like, yo, this is cool. So I was working at Standard Bank. Bonuses were paid September and March. So March 08, I get a bonus and I go buy shares. 6 months later, I get another bonus and shares are like another 30% lower. Well, I buy some more shares. 6 months later, now we're in March 2009, I get another bonus and shares are down still more. So I buy some more. So I bought, went down lower, I bought more, and it went down lower and I bought more. The worst one of those shares was up 200% in 10 years. That was the worst one. So I just staggered my way in because I don't know where the bottom is. And there I was doing two things. I was buying individual shares and I was also buying some ETFs. I probably bought the top 40 ETF at around 14 Rand, 15 Rand. And today it's 95. And again, it's just that staggering in. So my ETFs, I carry on buying. Lows don't bother me. At times, there are opportunities. ShopRite, 270. Someone out there is, oh, ShopRite's crashing, the world is ending. No, man, we're still buying baked beans. 270 is where you buy ShopRite. You know what? And it might go to 250. It might go to 200. I don't know. I do know that I like it at 270. At 200, I'll buy even more because I've got constant cash coming into my portfolio. I just buy some more ShopRites. Not stressed by that at all. Crashes happen seldom. Important thing with crashes, an addition is left, but I've told them this already. People think crashes happen from highs. They happen from lows. Go back to every single crash, the 08-09, that week in October, the .com of 2000, the 1987, the 1969. Markets have run, and then they start falling, and then they crash. Capitulation. You don't capitulate at highs. You capitulate when the market's already 10, 15, 20% down. Then it crashes from lows, which is why when markets are falling, I'm scaling my way in. I don't wake up and say, you're 20% down, let me buy everything. But if I do wake up and a market is 20% down, I try and buy more. I try and buy more of my ETF I buy every month. And when the Rand strengthens 20%, I try and buy more dollars or euros or whatever currency you might be buying. It's either dollars or euros. No one's buying Swiss francs or sterling. So it's scaling my way in because we don't know where those bottoms are. And then you get the bounces. Man, those bounces are aggro. But they could just be a fake bounce and carry on down. Addition in the intro was saying, bear market bounce. A bear market bounce doesn't take you to new highs. That's called a bull market. Read Fooled by Randomness. Don't read his other books. Fooled by Randomness, the role that luck plays in your life. There are a couple of decisions which I will say were high skill and intellect, but there are about 3 purchases that if I remove them from my portfolio, my return is markedly lower. And if I'm really honest with myself, some of them had a lot of luck. Some of them, I can say there was only a little bit of luck, but you know, if you practice and do enough, you will get lucky often enough and it'll start to matter. Have lots of ETFs or collective investment schemes or Reg 28, whether it's unit trusts or your pensions or whether it's ETFs or something, have lots of that because it reduces the risk. The biggest risk to my portfolio is not orange people in the White House or interest or inflation. The biggest risk to my portfolio is me, and that I have infinite capacity to do dumb stuff. We all do. And I reduce that infinite capacity to dumb stuff by having collective investment schemes. For me, it's ETFs predominantly. I've got some Reg 28. For me, it's mostly going to be the ETFs. More is better. And I said this before, for the average human being out there in the streets of Johannesburg, they should have 100% of ETFs. You've come to a Power Hour event with Standard Bank, you're not likely to be sitting in 100% ETFs, but don't be worried. As I said a moment ago, my ETF holding is around 55, 60%. It depends on some T's and C's. If NVIDIA is doing well, then it's lower, etc., etc. It's the best defense against yourself. And then it just helps, and I mostly keep it simple. I buy my global ETF, diverse, 10,000 stocks, 9,000 stocks in it. And it's emerging markets, and it is developed markets and everything. Local, it's global. If you're buying it offshore, the code is VT, same index. And then I will put some thematic around it. So at the moment, my thematic is resources, which has been spectacular. I have to be frank. I bought the resources, and for a long time they were going down, down, and down, and down. And then they went sideways and sideways and sideways. And then finally, after about a year and a half, that's what resources do. Wayne McCurry, I don't know if you've ever met him or seen him on TV. When he would be on Stockwatch, he would say to you, look, it's really simple. Resources are at the low. One day, they're going to shoot the lights out. Which day, Wayne? Oh, I don't know which day. He doesn't even know which year. He just knows it'll happen. And he was right. So at some point, I looked at resources and I'm like, man, these things are beaten. Apart from gold, every resources, and at that point, gold was like, I think 2,200. Everything here is just ugly. I buy some resources. And it was painful for a long time, and now I'm in the profit. So I do a bit of thematic, but I do very little. I like tech, so I've got the ETF 5IT. From One Invest, it takes the IT stocks from the S&P 500. So it's predominantly Apple, which I'm not thrilled about, Microsoft, Alphabet, NVIDIA, no Amazon, because Amazon is a consumer staple, consumer stock, not an IT stock, according to NASDAQ classification, or S&P, whatever. So I do take some thematic in that regard. And I can tell you what, and you all know it, am I going to be good at selling it? No, probably not. The beauty, I do it in my tax-free account. So I can be quite nimble because there's no tax implications, there's no worries. And when you get it right, I had banks a little while ago, and that went really, really well for me. But I'm keeping it quite simple. I'm not going to rush off and go and buy India or something. I was buying some Europe earlier this year because of Trump. Enough said. But I'm very careful in my thematic. At the moment, all I hold in thematic is some, I think I've got some Japan for my nephew. I've got some Europe. I've got some 5IT tech and the Resi. And that's pretty much my thematic at this point in time. And then I have global. When I changed my mind as to what my default was, I used to be buying the F&B 1200, and then I switched to the global. I don't go and sell those ones. The F&B 1200 held 1200 shares. It had a slightly higher TER, and 1200, the global's got a better TER and a much more diverse, so I jump into that, but I keep the other one, because if I'm selling it, it's not sitting in my tax-free. There's tax implications. I leave it. I'm happy. And in time, the other one will overtake it and become more meaningful. More on ETFs. We've got a blog. We've also got a database. It's in beta, justonelab.com/ETF database. You can go and try and see if you can, I don't want to say break it. No, don't try and break it. Like be a little rough, but like not too rough, like not dangerous rough with it. Because my databasing skills are not necessarily the best in the world. And don't over diversify. I remember a client's portfolio once. He had 102 shares. I'm like, dude, buy the top 40. Oh, yeah, no, but this one, the fun thing was he had a story for every one of those 102 shares. I'm like, dude, but if you're right on 20% of them, he says, I'll do brilliant. I said, no, if you're right on 20% and they double, your portfolio's gone up 20%, assuming none of the others fall. Depending on if you've got a portfolio with a good chunk of ETFs or collective investment schemes or whatever, then you can fairly concentrate down to a dozen or 15. If you're just looking at stocks 25 to 30, probably we've all got some level of collective investment scheme there. And I know what you're all thinking. You're thinking to yourself, yowza, how do I narrow it down to a dozen or maybe 2 dozen stocks? There's so many brilliant stocks out there. That's the point. There are not so many brilliant stocks out there. There are lots of stocks going higher, but don't mistake higher for brilliant. You want the stocks that are both brilliant and going higher. There are some companies out there which are decidedly B grade, very high. And my example to you is the GPL1 drug manufacturers, Eli and Novo Nordisk. I mean, do they have a drug which is material? Yes. Do they have a drug which is game changer and for which they can charge thousands of dollars per patient per month? Yes. Is that going to remain true? No. Novo Nordisk forgot to renew their Canadian patent. To be clear, the cost of renewal is $250 and you have a 1-year window. They forgot to renew, so now generics can be sold in Canada. So yes, they have something game-changing, but those valuations were insane. And eventually their patent runs out. And then everyone can make it. And now where are you? So don't mistake a all-time high for a brilliant stock. So having less is lacquer. Because it means you can't have Woolies, Boxer, ShopRite, Pick and Pay, and Spar, because that's 5 stocks and that's already a third of your quotient. You've got to pick one. And if you want to be big on tech, buy the tech ETF. You don't have to go and buy, what are the good tech stocks out there? You want some Microsoft, you want some Alphabet, maybe you want some Netflix, you want to throw in some, and suddenly you're at 10 or 15 stocks. Part of the trick is that when you've got that many stocks, you're not doing good diligence on managing them. Assuming you have a job and a life and a family and all those other things. I mean, if you're just spending 24/7 managing stocks, then go for it. But this, for most of us here, all of us here today, is not our primary job. It's something we do on the side. We've got a certain amount of time for it. If you've got 50 stocks, my argument to me is you don't have a good enough filter process to find the brilliant ones. And I've done this. I mean, I just used to, I did it particularly with ETFs. Every new ETF that came out, I bought some. At one point, I owned 30 ETFs. There were only 34 ETFs on the whole market, and I owned 30 of them. It's like, yo, dude, that's like approximately 28 too many. So I just trimmed and over time cut them down. Some I kept, some I haven't bought in ages, but I've kept them because they're a big holding and tax implication, etc., etc., etc. But less, because it concentrates the portfolio, and massively it concentrates your thinking to that portfolio, to what those stocks are, to which ones you're holding. Because if you're just buying every stock David Shapiro talks about on TV, firstly, you've got 30 stocks, 40 stocks, 50 stocks. And secondly, what's your logic? Is David going to phone you when it's time to sell? He hasn't phoned me, and he even has my number. Actually, he has my number. To be clear, he's never phoned. I phone him because he's David Shapiro, man. Come on. So quick bonus ones. Trading is hard. I didn't talk about trading this evening. We've got 2 webcasts up, justonelap.com/power hour on trading. Trading is hard. Those who think you hate your job, you'll become a trader, welcome to losing money. No, trading's like anything else. You've got to learn the skill. Why do we think that all we got to do is fika? I know, you go along, you do your fika, you put in 10 grand, you think that was easy. Yeah, you're about to get parted from your money. It will be quick, it will be violent, it might even be bloody. Luck matters. I said that already. Don't be embarrassed by luck. It doesn't happen often, but you know what? If you it was Gary Player or someone, if you strike enough balls, you're going to get lucky from time to time. And when it happens, embrace it. It's a lovely thing. It's not frequent. Volatility is a feature of markets, not a bug. Use it to your advantage. When things are selling off, there might be opportunity, depending on T's and C's. But market declines are nice things. Hype and FOMO are your enemies. Fear of missing out. The new exciting things. Is AI real? Yes. Is it a game changer? Yes. Will it be with us for the rest of our lives? Yes. Unless, of course, it takes over and kills us. But understand where in that hype field you want to be. Distortion reality field. Where do you want to play in it? Understand that hugely. Complexity reduces returns. As human beings, we are wired to believe that harder is better, that more complex is better. And that is quantifiably not true. Everyone always says, when you were at school, everyone told you, work hard in order to get rich. We all know some lazy so-and-so who's never worked a day in their life and they're rich. Warren Buffett's children, he only gave them $1 billion each because he didn't want to spoil them. Please don't spoil me, sir. Complexity is not equal return. Does not equal better. Simple always wins the day. And within reason, T's and C's, you understand that, but simplicity. And don't buy shares with debt. Buying shares with debt is great when stuff's going up. It's really, really bad when stuff's going down. Again, T's and C's. Brokers these days will do you some share lending, but be careful with how much you borrow against it. A broker says you've got 100K, we'll lend you 100K, but then it falls 10K and they sell you your shares because you got debt, now you got zero. Careful how much you leverage. Look at the interest rate because that's your hurdle rate. You've got to beat the interest rate to make it worth that time. Be careful. We're always learning. No one sits back and says, that's it, I know it all, I'm king of the mountain. Nah, because as soon as that happens, like someone will take your knees out. We're always learning. We need to think long term. It sounds easy to say, it's harder to do. When we think long term, it makes the process easier. It removes some of the fear. A market crash, when you're thinking in decades, is neither here nor there. It still is right now, but it's not going to stress the heck out of you because it's just one of those things. Have a plan and keep your plan simple. Your plan will probably change. My plan has changed. I expect my plan to change again. If nothing, one day I'm going to get older and my plan will change. But have a plan, even if it's a rudimentary plan. Even if your plan is initially it's just like, man, I want to have more money. Okay, it's not much of a plan, but you know what it is? It's a plan. It's a start. You can thrash it out as time goes on. You can make it a better plan in time. Ignore the crowd. The crowd is, you've all seen that cartoon where everyone's mind blank. In a sense, the market is the crowd, but be careful of I'm talking Renogen as a meme stock. To be clear, I was in before it came meme. I would never buy a meme stock. Fun fact, friend of mine, I won't say his name, might be Petri. A couple of years ago, cannabis was all the excitement. So there was a cannabis meme stock that he wanted to buy. He bought the wrong stock. Turns out the stock still went up because he wasn't the only one who bought the wrong stock. The point is the right cannabis stock went up 200%. His wrong cannabis stock, which wasn't a cannabis stock, only went up 50%. Careful of the crowd. Again, I come back to we're always learning, and ultimately it becomes easier. Not because we become gurus, not because we become king of the hill, But I think because we start to realize what we can do, what our limitations are, and also as we do it, we start to have some track record that gives us a bit of confidence. I've got shares that I can look back and say, yeah, I bought ShopRite for $8 or whatever, and my dividends over the time's probably been 20 or 30. I can say that because of 20, 30 years. When you're early in the days, you don't have those stories, but they will come. They absolutely will come. Bit of discipline, bit of focus, bit of valuations, bit of keeping it simple, bit of luck along the way. Those stories come to us in time eventually for all of us. Next month, we are back, listed property. August, it was going to be Mishima Gama. She can't make it, so we've moved Mishima to September. I hope we are back in the main building across the road, and then we will figure the rest for the rest of the year. JustOneLap.com events. This has been recorded. You'll find it at JustOneLap.com/power hour. Ladies and gents, I have run my time. I've got terrible at time, but if there are some questions, I will take some. So.
Just interested to hear your thoughts on how to manage tax. So when you talk about your tier 2 and your trading.
Yeah. So the question is around tax. And okay, so short answer is you're going to pay it. A couple of things. Firstly, max out Reg 28. Secondly, max out tax-free. Then I have two separate accounts within the online share trading environment. So I log in, I got two accounts. The one is my long-term till death do us part, where when I sell, I'm going to pay CGT. Just nothing I can do about it. My other is my shorter term stuff, but again there, I'm typically holding, my average hold period probably close to 5 or so years, so it doesn't mind about that, and SARS will say, fine, again, that's CGT. I've then got a trading portfolio, and that I keep fundamentally separate, because on that, I pay income tax. I can deduct my expenses, whereas I can't on the others. Expenses would be data, transaction fees, losing trades, subscription to Business Day, whatever. You can deduct those. Some people say put it into a company. That loophole's been closed. You got the company essentially gives you a SARS gives you a loan because you can, but at some point you're going to pay company tax. That's 27. At some point you want to take a dividend. That's another 20. Now you're at your marginal tax rate.
So sorry, Simon, what mechanism did you keep it separate? How do you make it separate?
They're just in separate accounts. Separate accounts. Yeah. So I can say this is trading, this is investing, and you can look at the data. And you know what? And sometimes you buy a share with the intention of long term, because remember, tax is always around intention. Very hard to prove. But if I've bought it in my second tier portfolio and a bad sense announcement comes and I sell it a week later, I can kind of prove my intention.
And sorry, I'm being stupid, but what does it take to convince SARS that they're separate accounts?
Oh no, no. So they both sit with OST. They got different BDA numbers. So I get that different tax reports, I get different IT3Cs, and all of those documents are, it's for Simon Brown, my ID number, but they're fundamentally separate. Correct. Your main and tax-free separate. Yeah.
It's been posed to us from a lot of clients as well. It's hard to buy winners. Like right now, for example, buying a capital. When do you start to actually look at the price? And when do you say, okay, this winner actually run? Is it still going to be a winner? How do you start to look?
So if it's a long-term winner, it always comes back. You could have bought Capitec for 2,450 Rand on the 9th of April this year, and it's now back to 3,500. The market gives you those opportunities. You just need to be ready. What I don't do anymore, because I spend my days in front of markets for my sins, I used to decide this was a price I like, and I would put an order good for month into it. So, you know, Capitec at 2.5 was a steal. But you look, you know, you decide what a price that you like, and you say, cool, if this stock is that price, put the buy order in. One day you get the SMS and it's been hit. To your point, some of them run away. You know, there are, and I can't think of one now, but there are stocks I know that I wanted, and I just never got them. Now, I should have paid up for that one, but if I'd paid up for all of them, I would be worse off. If I'd paid up for Capitec and ShopRite and other winners, etc., I would be worse off. Yes, I can identify the one that I missed, and I wished I hadn't. But paying up is dangerous, because if you pay up for all of them, then you've paid 3,500 for Capitec and it's still there. And, you know, are you going to make money on that? Yes. But are you going to make a good return on it? Not from that level. So I would rather miss a stock. And to be clear, it's painful. Like, there is no fun. You know, you had it, you saw it, you wanted to buy it, you didn't. Now you feel stupid. But go and say, well, what if I'd done that for 10 stocks? That one got away from me, but what about the other 9? So. Am I going to? It's a great question. What keeps me motivated? And it's my, yeah, so it's my job. I love it. I love the data. I'm a numbers nerd. I mean, numbers are my fun. Numbers are what make me happy. Throw me, you know, equations and Excel spreadsheets and stuff, and that's what makes me happy. So I'm a numbers nerd, and I love the numbers. I think I'm afforded a deep luxury that this is also my job. You know, tomorrow I'm going to spend, I have no TV and etc. I'm going to spend hours tomorrow just watching markets and reading at results and stuff like that. And I think it, you know, hoy man, I get paid to do this is just like completely ridiculous. What keeps me motivated beyond just the fact that I enjoy it and it is my job is that there is a satisfaction to it. There is a reward to it in that your portfolio grows and you beat the market and you get a little bit richer. To be clear, there is nothing wrong with saying, you know what, to hell with this, I'm just going to buy the ETFs. And that's what most people do and what most people should do. Now, in theory, I can beat those people. In practice, everyone can't beat those people. Half can before costs. Remember, 15% of active investors beat the market. In other words, 85% after costs get beaten by the ETF. And that's the stark reality. And now, as small investors, it's harder to beat the market. As smaller investors, because we don't have access to data, information, research teams, etc. As small as investors, it's easier to beat the market because we don't have access to data, research teams, etc. And I can go and buy Renogen or Purple or Calgro. Coronation can't. Alan Gray can't. They're too small. So I can go places where they can't. Adrian Saville talks around that. He did a power hour for us last year. You'll find it on the video. He talks around the idea of not having liquidity constraint, where you can go and buy that little penny stock because we're coming with 10, 50, 100,000, whatever. Even if it's $1 million, we can do it. Coronation's coming and they like if it's under 100 million, they're not interested or whatever their number is, which means that their investable universe on the JSE is 60, 70 stocks. For us, it's 300. And that gives us a real edge. Folks, I'm going to park it there because I'm running my time, but I'll stay around. We'll take more questions. There's a disclaimer, as always. As I say, we are back again next month. Always appreciate folks on the webcast. And maximum appreciate people coming through to a physical building. Always fun. As I said, we are back and we'll be back in main auditorium next month. Thank you very, very much for your time.